I am Jeremiah Ajuda Dusu, the author of Jad's Business and Financial Accounting.
If y'all gonna cheat, you know what I'm saying? I'm gonna go and tell them things. You know what I'm saying?
Hello. Okay. So we're still on group balance sheet, right? Last class we talked about dividends. Okay, but the scenario there was that the holding company's policy was to account for the dividend when it is received. Okay, so in this class we're looking at something different. So this one saying what unpaid what dividends by subsidiary accrued for by parent, or you can say accrual of dividend declared by subsidiary by what? Parent. Accrual of dividend declared by subsidiary by the what? Parent. What I'm trying to say here is that the subsidiary declared dividends, okay, but they've yet to make, or they are yet to make payment. That means they've not made payment, okay. So since they have not made payment, it means that it's a proposed dividend, okay. Now don't forget that dividend from the perspective of the holding company is an income. Now the scenario we're looking at here is that the holding company is accruing for the dividend even though it has not been paid. That is, they are accounting for it even though it has not been paid. So they are accounting for it in the year that it relates to. So it means that if the subsidiary declares dividend, let's say for 2015, let's say dividend declared is what? 200. Remember, it's directly to what? We have monetary interest to take and then the holding company, right? Or what they call the parent company. And let's assume that monetary interest is, let's say 20 naira. Holding company will be 180 naira. Now this is from the perspective of the word subsidiary. Subsidiary declares dividends. They are expected to pay it to the minority interest and the holding company, right? But what we're saying is subsidiary declares but has not paid. Now from the perspective of the word holding company, to the holding company or to the parent company, remember dividend is what? An income. Now the holding company wants to account for it in the year that it relates to, even though it has not been what? Paid. So dividend declared is for 2015, though it has not been paid, the holding company wants to accrue for it in 2015. That's what we're looking at here. And don't forget, I already told you accruals, accrued income, accrued expenses. There's a class on that already. Okay, so I think that we should understand how that operates, right? Remember that, from an income perspective, if an income accrues, it means that you have earned it but you have not received it. So that person that rendered the service, or that person that the money is due from, becomes a debtor in that sense. So accrued incomes are like assets, right? Now when you say accrued expenses, it means that you have incurred that expense but you have not paid, right? So from the perspective of the whole of the subsidiary, the dividend is due for payment but has not been paid, so it's more like an accrued expense, right? So it's a liability from the perspective of the what? Of the subsidiary. But from the perspective of the what? Of the holding company, the income is due but has not been received. So it's an asset from the perspective of the what? Holding company. But don't forget, the holding company will only account for his own share. So from this scenario, the holding company share is 180. So the holding company will only account for his own share. So it's not cannot be received, but they want to account for it. So what should have been done is to what? Debit what? Accrued what? Dividend, right? From, let's say, the subsidiary. That will be what? 180. Right? Then you now credit what? Profit and what? Loss with what? 180. Now don't forget that for your dividend, which is an income from the perspective of the what? Holding company, to go to profit and loss, it must be what? A post acquisition what? Dividend. So if this is a post acquisition dividend, this is correct, right? But if it is a pre-acquisition dividend, then it will be what? Debit what? Accrued dividend, right? Which is the sub, the 180, and then you credit what? Cost of what? Investment, right? With what? 180. Of course, that is if it is a what? Pre-acquisition dividend. So if what has been credited to the P&L, if it is not entirely post, I already explained before, you have to take out the what? Pre-acquisition elements, take it to cost of what? Investment. If what you took to what? Cost of investment is not entirely pre, take out the post elements and take it to where? Profit and what? Loss. Now don't forget that this is a debit balance, so it's more like what? An asset, right? So some suggestions might use dividend receivable from what? Subsidiary. So instead of using accrued dividend, they might use dividend receivable subsidiary. It's the same thing. Okay? The same approach. The same thing here. Dividend receivable from what? Sub. So if you debit dividend from sub or dividend accrued dividend from sub, you're crediting cost of dividend if it's entirely pre-acquisition dividend. If you're debiting this and crediting this, it is post-acquisition dividend. So where you're having a combination of pre and post, you have to raise journals and take out what? The respective items to where they are supposed to go to. Now, at consolidation, don't forget that the subsidiary is holding the parent company as what? As a liability. And then the holding company is holding the subsidiary as what? As an what? Asset. So you can see more like a debit of 180 here, equal and opposite with what? A credit of 180 here. So it means that at consolidation, this is expected to cancel out what? This at consolidation. So remaining only the minority what? Interest. So this can appear as what? Dividend due to what? Minority what? Interest as a liability. That is at consolidation. Okay? So what I've simply said here is that dividend can be declared by the subsidiary but not yet paid. And then the policy of the holding company will be to accrue for it, even though it has not been paid. So the holding company will take it into account. Okay? So in that case, you're debiting the subsidiary as what? As a debtor sort of. So you can say accrued dividend from subsidiary, and then you credit P&L if it is entirely post-acquisition dividend. Or you debit accrued dividend, so 180, credit what? Cost of investment if it was entirely pre-acquisition what? Dividend. So if it is not entirely pre, raise journal, take out the post and take it to P&L. If what is here is not entirely post, raise journal, take out the pre and bring it what? Here. Okay? So this is, summary of, accounting for what? Dividend declared by the subsidiary that is not yet paid to the what? Holding company, but the holding company is what? Is accruing for it or is taking it into account as an income, even though the subsidiary has declared it but not yet what? Paid. So take your time, go through it. If you have questions, you can reach me on the number displayed. I'll just reply with the right answer. So let's quickly take a simple question that will give us an idea of what we are talking about here. So let's quickly take this question so we can have an idea of what we're talking about there. So we have the following represent the balance sheet of Kings Limited and Queens Limited as at 2017. So we have Kings and Queens assets, we have land and building furniture, debtors, then we have investment in Queens, accrued dividend income, Queens, okay? So that means they are accrued for the dividend here. And then we have cash at bank. Then we have that means the share capital ₦1 each, reserve, proposed dividend. So Queens proposed 400 naira dividend, right? Okay. They say Kings Limited acquired 70% shares in Queens Limited on 31st March 2017 when reserve was what, 200,000 naira. Okay. Now Queens Limited proposed dividend of 20 kobo per share for 2017 accounting year. It is a policy of Queens Limited to pay dividends in the second quarter of the following accounting year. Kings Limited policy revealed that dividends from investments are accrued for as incomes in the year which it relates. So you are required to pay the consolidation schedule and consolidation statement of financial assets. So here it's saying that Queens proposed dividends, okay, for the 2017 accounting, but they've not paid it because their policy is to pay in the quarter of the following accounting year. But Kings, which is the holding company here, has a policy that accrues for dividend from investment. And then here they are saying that the policy reveals that dividends from investment are accrued for as income in the year which it relates. That means when dividends are declared by the subsidiary, then they were recognized as an income. So that means they must have been taken to the profit and loss. Okay? So but don't forget that we have to be sure that it is post. If it is not post, then we have to take out the pre-element, right? Okay, so let's do what I want to do here. Right? So we have cost of control, right? 70% according to the question. Okay. So this will be minority interest will be 30%. This will be consolidated profit and loss. Right? Okay. So let's go. We have Queens. What's the share capital of Queens? $2 million, ₦1 each. So 70% of this is how much? $1,400. So this will be what? 600. If you add this to this, you give you 2,000, right? Let's cross check. 0.3 times 2,000. That's it. So if you add, so let's go now. We have our reserve. What is the reserve? According to the question, we have 1 million. So we have reserve, of course, that will be Queens, right? Is 1 million. We now have it into what? Pre and post. So what's the pre item then? Acquired at the first matter, and when its reserve was 200,000. So we have 200. So this will be 800. So it will be times 0.7 times 0.7. So this will be minority interest will be times 0.3, right? So 200 times 0.7 there. $140. So we have 140 here. So 800 times 0.7 there. we have 560. So 0.3 times 1,000, that should be 300, right? So let's check. 0.3 times 1,000. 300. So we have 300. That's correct. So if you add this, and this, what do you have? 140 plus 560. 140 plus 560 plus 300. 1,000. Okay? So we have 1,000. So if you add this up, this is what? 900. This is 0,451. This is net asset what acquired. So we have cost of what? Investment, right? What's it? Cost of investment is what? 4.3. But there's something that has to affect it there. There's a dividend declared by Queens. So that's 2017 dividend. How much is that? 400. So you have minority interest. That'll be 30% of 400. 0.3 times 4. 400. 120. So this is 120. 400 minus 120. That's what? Parent company. That's 280. Okay? Now we have to know if it is pre. Is it pre or post? Is it pre or post? When was it subject acquired? 31st 2017. So that dividend is related to what? Profit before acquisition. So this will be what? Pre. Right? Now, remember, for pre, we're expected to have what? Debited accrued what? Dividend income. Right? With what? 280, right? And then credit what? Cost of what? Investment what? So this is the right thing because it's a pre-acquisition file. It's entirely pre. But they are saying that the policy reviewed that they accrue for it as an income. So they're taking it to what? To the reserve. So we have to read the journal for that. So we have reserve for what? Kings. Balance brought forward. What's the reserve for Kings? 2630. 2630. Now remember, they have accrued for dividend as an income, so it has gone there, but it's not post, it's pre. So it has to come out. So how do we take it out? We have to debit this guy here. So we say cost of investment, how much? 280. Excuse me. So what do you have? Balance carried down, 2630 minus 280. 2630 minus 280. We have 2350. So we have 2350, right? So that'll be 2630. 2630. So our new balance here will be 2350. So the next one here, cost of what? Investment. Of course, that's Kings, right? So we have balance brought forward. What's balance brought forward? We have 4,300. 4,300. So we have reserve, okay? That's 280. So we have balance carried down. 4,300 minus 280. 4,300 minus 280. What do we have there? 4020. 4020. We have 0,034. So the new balance is 4020. So we've been able to adjust for the what? Dividend. It's a pre-acquisition dividend, and then we already know how to what? Make those entries. So let's check again. We have 2,630 minus 280. That's 2,350. Right? That's the new balance for the reserve for Kings. All right, and then for cost of investment, we have 4,300, of course, 4.3 million. Remember, then we take out our 280, we have 40. So this is the new balance for the cost of what investment. So that comes here, 4020. So we take that out, right? So what do we have? 4020 minus 1540. 2,480. So this is the goodwill. 2,480. Right? So we have the goodwill here. And minority interest. That would be what? 900. Then we have King's Reserve, which is this. Comes here, 2,350. So we add this to this. What do we have? 2,350. 2,350 plus 560. 2,910. So this is your consolidated profit and what? Loss. So let's prepare the what group balance sheet, or we call the consolidated of your financial position, right? So you understand what we've done here. This is just the same thing we've been doing, but we're able to adjust for the cost of investment and the reserve as a result of the fact that the dividend that was treated as an income, okay, to the P&L is entirely pre. So it was entirely pre, it shouldn't be there. It should go to cost of investment. But if it was to be entirely post, then it was okay there. Okay, so that is it. So let's proceed. We have Kings and its subsidiaries. So we say what? Statement of what? Financial position as at the 1st December 2017, right? So we have the notes, we have assets. So we have the non-current, let's call it note 1. So let's put the note 1 here. So what are the non-current asset items? Land and building. We have land and building. Let's call it land and building. So what are the items there? We have, what do we have there? 800 1090. So that will give us what? $800 plus 1090, 1890. 1890. So what's the next one? Furniture and fittings, we have 700, 740. F and F, 700, 740. So what do you have? 700 plus 740, 1440. So when you add up, what do you have? 1890 plus 1440, 330. 3330. Right? 1440 plus 1, that's 3. So that means this is what? 3330. So let's go now. We have the current, which will be known to what? 2. So let's put that here. Note 2. So what are the items? We have debtors. So what debt do we have there? 500, 570. So what do you have? 500 plus 570, 1070. What's the next item? Accrued dividends income. Remember, this dividend is proposed. This is proposed. So we have minority 180, then 280 for what? Holding company. Now, in the book of the holding company, it's an asset because it is due from the what? Subsidiary. But in the book of the subsidiary, it's a liability because due to the what? Holding. So the holding company is holding the subsidiary as a debtor, technically, while the subsidiary is holding the what? Holding company as a liability or as a creditor. So it's equal and opposite. So that 280 here will cancel that other one there. So we now have bank. So what's the bank there? 551 million. Excuse me. So what do we have? 550 plus 1 million. 1550. Any other item there? No. So let's add up here. 1070 plus 1550. 2620. So we have 2620. So what's our goodwill? Goodwill here is 2480. So when you add up, what do you have? 330 plus 2620 plus 2480, 8430. So let's go liabilities now. What's the reserve? Reserve here is 2910. Share capital. Holding company share capital is what? 4.5. Then we have minority interests. What do we have? 900. Right? Then what do we have there? Dividend due to minority interests. 120. Like I said, the 280, of course, is totally declared is 400 proposed. 280 for parent company, 120 for minority what interest. So the parent company has already accrued. Okay, the adjustment we did here was to take it to the appropriate place. The parent company accrued by debiting accrued dividends, okay, due from what the subsidiary, which is coins, but credited what profit and loss. But we found out that what the dividend is what a pre-acquisition dividend, so it shouldn't go to P and it should go to what cost of it. That was it for this one, okay. But then we must not forget that the debit entered in accrued dividends, that's like capturing the subsidiary as what as a debtor. But the subsidiary also capturing the company as a creditor, so that is equal to what? It will what cancel out was equal or opposite, right? That's why the 280 is going out, right? So with this, we can add up. So we have 2910 plus 4500 plus 900 plus 120, 8430. Okay. So this is your total assets. This is your total liabilities, right? So basically what we've done here is to prepare consolidated what balance sheet or statement of financial position. Of course, taking into consideration, dividends that has been declared by the subsidiary but not yet paid, and then the holding company is accruing for it, okay, in the year that or for the year that it relates to, okay. And then we're able to establish that even though the accountant has taken the right step, of course, there is a bit of what, an issue with where the dividend is accrued to, because it's a pre-acquisition dividend. So I already explained how to treat pre-acquisition dividend and how to treat what post-acquisition dividend. So we found out that what it was a pre-acquisition dividend, but it was treated like post. So we raised the journal to correct that before we're preparing the what consolidated what balance sheet. So that's what we've done here. Okay. So take your time, go through it again. If you have questions, you can reach me on the numbers displayed. I'll let you reply with the right answers. See you next class. And don't forget, you can support us by printing account numbers displayed or sponsor copies of my textbook for free distribution. Thank you.